about stock exchanges and capital markets. Bombay Stock Exchange is one of the oldest stock exchange in the world. With economic development witnessed in the country under the 5-year plans, Indian capital market has acquired a unique status. Especially in the last decade, both the primary and the secondary capital market have witnessed an explosive growth. The number of stock exchanges, listed companies, market capitalization, trading volumes and capital raised through new issues has grown substantially. In order to ensure the continued growth of the capital market, protection of the interest of the investors is a necessary condition. This in turn requires that the market is both efficient and fair. After some happenings of the recent past, such as the securities scam, the need for effective regulation of the securities market has been clearly highlighted. What has been the state of the Indian capital market in the last decade, and where will it tend to go in the coming future?
Well, I think one thing is certain, that the Indian capital market has already changed a great deal in the last 10 years, much more than it probably did in the preceding 20 years, and it certainly is going to change a great deal more in the years to come. And the change will be essentially, I think, in 2 ways. One, so far, its Indian capital market is really dominated by the public sector, and most of the financial institutions are in the public sector, the commanding heights of the economy and all that. We're going to see more and more private institutions, private mutual funds, perhaps more foreign banks. Certainly, the stock exchange in a way is a private institution because private savings go directly into private companies. But maybe the public sector will be brought more into the capital market in terms of their issuing shares and borrowing and all that. So they will get somewhat similar to the rest. So that change would be there. There would be a change, I think, in the nature of the degree to which economic policy or financial policy limits the freedom of financial institutions. If you have administered interest rates, the government tells you where to invest, at what rate to invest, what rate for interest to offer on deposits and other things, then naturally the scope for initiative for financial institutions is that much less. So that kind of thing would be, because there is a general policy of the regulation, there would be greater risk in the market, because you cannot have a freely functioning market when things are not given to you, and yet not have new risks. So on the one hand, there would be more private players. On the other hand, there would be more risk. I must say, though, that I don't think that the predominance of the public sector in the next 15, 20 years will be very greatly reduced. It will be reduced, but I think there will still be a major player. You mentioned disintermediation. Now, disintermediation really means that the market gets so sophisticated that you don't need, for a company which ultimately borrows and the individual who ultimately saves, you don't need anybody to come between them. The private savers know so much about individual companies that an individual company can float its own shares without anybody underwriting them, can float its own debentures without any financial institution taking them over in the first case. It's beginning to happen in more industrialized countries, and to a certain extent it will happen here. But I'm not sure that the role for intermediation in a country like ours, where there is still a lot of unorganized market, there is still a lot of general ignorance among the ordinary small investor about what the capital market is all about, that you can do without financial intermediaries. I won't expect that the role of financial intermediaries would be reduced a great deal.
We hear that in the coming future, Indian capital market is poised for qualitative change. The role of the private sector is going to increase and the market will be opening up. Will this new freedom require more regulation?
But the regulation of the capital market essentially is for two reasons. One is that the capital market ultimately depends on the volume of private savings, or household savings as we call them. Now, an individual who saves will not invest in a company about which he doesn't know very much unless he feels that there is some security for the savings that he invests, that he will not be cheated, that there will be not some kind of hanky-panky in the company whereby he as a shareholder is denied the benefits and some small group of people gets the benefit. That is one purpose of regulation, to, if you like, create a confidence among individual small savers so that the flow of savings is greater than what it would otherwise be. But there is also another kind of regulation which is, if you like, derives its rationale from the community's interest. The community's interest is not only that savings increase, but they are directed toward the most productive uses. And that requires that in some way if the market distorts the signals, then somebody should try to correct the signals or say what the correct signals are. So I think that sometimes is not remembered.
The Indian primary capital market has grown 55 times in 8 years. Similarly, the market capitalization of secondary market has grown from 10,000 crores to about 1 lakh of crores in just 10 years. This is a development that India should be very well proud about, and it's a lesson for many of the developing countries to look to India as a model rather than go to the West, because the Indian experience is more relevant to their economic growth and to the growth of their financial markets.
We thus observe that the securities market has explosively grown in the last decade, and the trend is likely to continue. So the need for effective regulation is equally high. The Government of India has taken initiative in this regard by creating SEBI. The Securities and Exchange Board of India was first created as an administrative body in 1988 and then for issuing an ordinance in Jan 1992, which was replaced by an Act of Parliament in April 1992. Well before the ordinance was issued, G.V. Ramakrishnan, chairman of SEBI, spoke about the reason for the creation of SEBI.
In the last few years, there has been a very fast growth of the Indian capital market. The amount of household savings that have been coming into the Indian capital market has gone up very steeply. Therefore, government thought it was necessary to bring about adequate regulation of the capital market so that it can promote the healthy growth of the capital market and also provide adequate protection to the small investors. That is how SEBI was created in 1988.
What are the specific objectives of SEBI?
The objectives of SEBI are to promote the healthy growth of the Indian capital markets and to protect the interests of the small investor and to allow companies and issuers to raise funds in the capital market in a fair and equitable manner, in an efficient and a cheap manner, and to allow the intermediaries in the capital markets who are between the issuers and the investors to compete with each other in a fair and open manner and to provide good and honest service to the investors.
But how would you satisfy all the three parties, namely the issuers, the investors, and the intermediaries?
See, all the three parties constitute the capital market. You cannot have a capital market with issuers only, or with investors only, or with intermediaries only. All of them are an integral part of the capital market. If you want the capital market to grow in a healthy manner, all the constituents of the capital market should work in an honest, efficient and a fair manner in dealing with each other and dealing within themselves.
While the objectives and the approach of SEBI are clearly aimed at building up integrity, fairness and transparency in the market, the real challenge would be how to do it.
The integrity fairness and transparency are all interconnected. If you have to have integrity and fairness in the market, the first requirement is that there should be honesty in dealing with each other and in dealing with the investors. The second requirement is that honesty should be not only there in actuality, it should also be seen to be there. It should be open honesty which people know is there, and the investors therefore gain confidence. If you have transparency, the honesty will be known to the others. It is not a secret fact that one is honest among oneself or to himself. Investors should also know that they are getting fair treatment from the intermediaries and from the issuers. So transparency is essential to convince the others that there is honesty in the system. If intermediaries have honesty in dealing with each other, that should also be known to others. If intermediaries are honest in dealing with investors, that should also be made known. Therefore, transparency is brought about by better disclosure and better dissemination of information to be shared by all the parties.
What mechanisms do you have in your mind?
To have an efficient allocation market, we should know that the market itself is open, efficient and transparent. It means that the information available to all the players in the market should be substantial and adequate. That no single group in the market has access to special information which is not available to others. If people deal in a market where information is available only from sections of the market and not to everybody, then it will not promote efficient allocation of resources. So dissemination of information, transparency in dealings, and avoidance of practices like insider trading will all contribute to greater integrity in the market and will promote the more efficient allocation of resources.
It is well known that the heart of the matter in the regulation of securities market is the protection of investors' interest. But how will SEBI do it?
Investors have many types of problems. Starting with the primary market, if an investor wants to apply for shares or debentures that are offered to him, he must first of all have full and adequate and honest and truthful information about the company which makes the issue. That is the first stage where the investor should be served properly. Secondly, the intermediary who promotes the sale of the shares or the debentures should also cooperate in giving him adequate services after he makes the application in the allotment process. After the allotment is made, the investor has problems in getting his share certificate or his debenture certificate or his allotment letter. These are factors that affect investor interest in the primary market. Then investor has problems in the secondary market also, where he transacts in the secondary market through stockbrokers and he either buys or sells shares in the stock exchanges. Then he expects proper and fair service from the stockbrokers. They should tell him at what price they bought from him, when they bought from him, and whether it's a fair market price prevailing on that day, and how much commission they charge for him. All this information should be given. Secondly, when he buys shares, he should be given reasonable assurance that he is buying genuine shares and he will have no problem in getting the shares transferred in his name. If the shares are properly delivered to him and then he applies for transfer of registration of the shares in his own name, the companies and the share transfer agent should also deal with him promptly and fairly. There should be no undue delay in transferring the shares in his name. So in all these areas, investor interests are involved in the primary market and in the secondary market. The last area where investor interests are involved are in the prompt payment of dividends and the prompt payment of interest on debentures. These are also major areas where investors complain that they do not receive dividends in time or the interest on debentures are not sent in time, and they have a number of complaints on that score. These are all the areas where investor complaints are there. They want to have fair conditions under which they can invest their money in shares and debentures, fair conditions under which they can hold the shares and debentures in their own name, and fair conditions under which they can sell these shares and debentures and get their money back. So our objective is to protect investor interest in all these areas.
Please spell out the nature of action that will be really deterring and exemplary.
there are a number of legal provisions even now. For instance, if a company puts out a false prospectus and tries to raise money in the public, that company can be prosecuted under the Companies Act. But very rarely have these provisions been used to prosecute any company. And therefore, there is a period that companies can get away by putting out incorrect, incomplete, or false information in the prospectus. Similarly, when there's a delay in refunding the money to investors, there are provisions in the Companies Act by which interest has to be paid to the investors and by which the companies can also be prosecuted. These provisions, again, have been very little used all these years. Now, as far as share transfer is concerned, there are provisions in the Companies Act which state that share transfers will be effected within 2 months. But in many cases, share transfers take months and months. So these provisions of the Companies Act are effectively implemented and effectively enforced, then companies will understand that they will be liable for penal provisions, they will be liable for prosecutions, in some cases for fines, in other cases even for imprisonment. And if these punishments are meted out, then many companies will be very careful in dealing with investors. Therefore, we are dealing with the cause of these complaints will be reduced, and therefore investors will be better served.
Now that SEBI has been a statutory body for almost 1 year, how has it performed?
SEBI has performed in the last 1 year as a statutory body. I think we must know that first of all, it was in April '92 that Act of the Parliament was passed, and under that the duties and powers of SEBI were clearly defined. If we look into the Act, Section 11 clearly states now that the major duties of the SEBI are, first is to protect the investor's interest. The second duty would be to promote the development of securities market, and the third would be to regulate the securities market. Now, in order to perform these kind of duties, the SEBI has been empowered under the same Act to take all such measures which it thinks fit to do. Under Section 30 of the Act, the SEBI has been given power to make regulation, and of course these regulations can be made only with the prior approval of the central government. And we also note that under Section 16 and Section 17, certain directives can be issued by the central government to SEBI. Under Section 17, the central government can supersede this board also. And if you look up Section 4, which talks about the appointment of the chairman and members of the board, we know that the chairman as well as 5 other members of the board will be nominated by the central government. What we thus see is that with the passage of this Act of the Parliament, SEBI has emerged as a statutory body and more like a nodal agency for regulating and developing the securities market in India, but it is also functioning more like an arm of the central government, and one cannot really see it to be a very independent kind of board. Now, what functions has it performed, what activities has it carried out? To tell you briefly, in sum and substance, it has issued number of guidelines, clarifications, notices, etc. Important guidelines which it has issued is, it covers intermediaries, it covers issuers. For instance, one major guideline which it had issued was for merchant bankers. There was guidelines for the mutual funds. For the asset management companies also it has given guidelines. Registration of stock brokers, sub-brokers, share transfer agents, and think of any other player in the market, and it has issued the guidelines. It has issued the guidelines on capital issues. It has also issued some guidelines as to how securities can be issued by the by DFIs, or developmental financial institutions. And I would thus say that during this period of about 10 months, since April, one can say from January '92 itself, when the ordinance was promulgated, it has done lot of developmental work, lot of educational role it has played. I think at this point one might also ask that how effective will it be as a regulator, because as far as its developmental role is concerned, its educational role is concerned, I think it has done tremendous during this short period of time. But how effective will it be in enforcing those laws, it has yet to be seen. In fact, the trends which we see in the market currently, some resistance has already been indicated as to some of the actions of the SEBI. Some of the experts have expressed doubts about the legality of the guidelines on capital issues, or what are also popularly known as guidelines on disclosure and investors' interests. I would also like to add that this registration fee for the sub-brokers and brokers, this has also invited some amount of controversy. So really what we have to see is that while lot of developmental activities have been undertaken by the SEBI, as far as the enforcement of these regulations is concerned, how effective will it be able to carry? Perhaps it needs the cooperation of all the parties, say issuers, intermediaries, investors. Of course, in India, unfortunately, we have had the experience of, say, a well-intentioned institution like CCI also, to allow it to degenerate into a dysfunctional regulatory body. But despite the fact that difficult backdrop in which the SEBI has been created, I think SEBI would be able to perform its function of regulation and development equally effectively, and ultimately protect the interest of the investors, which is really the key of the development of any capital market.